Hey, this is Greg Freeman from Freeman CPA, brought to you by Atlanta Business Accountants, and today I'm going to be speaking to you about health insurance. So, health insurance for the self-employed is its own world. Now, when we're dealing with health insurance in the self-employed realm, you have to keep in mind that the tax law tries to keep everything the same. So, whether you're self-employed or you're employed by somebody, the tax law sees this almost as one and the same. The only difference is that when you're self-employed, you're considered both employee and the employer at the same time for tax purposes. When you're employed by somebody, you're just the employee. Now, when you're an employee of somebody's business and that employer pays for your health insurance, that's going to be a deduction for the employer. Okay, for you as a self-employed individual, you will also obtain this deduction. The only difference is that when dealing with self-employment, that the reporting is a little bit different. Now, when I'm speaking about self-employment here, folks, I really mean pass-through entities today. I'm not discussing C corporations, so I'm going to speak specifically about S corporations and LLCs and single-member LLCs or sole proprietors. These are pass-through entities or just simpler forms of filing. Now, the health insurance is, very specific. There's a specific tax law that deals with health insurance of S corporations. So this segment really specifically wants to address the S corporation. So if you're an owner of an S corporation and you own greater than 2% of that S corporation as an owner, then you have to report your health insurance premium that you're paying for yourself as your compensation. It's deemed compensation to you. So being that that's deemed compensation for tax purposes, that has to be then reflected as part of your salary on your W-2. And then your salary and your W-2 will reflect that in box 1 of your W-2. It will skip box 3 and 5 because this is not going to be subject to Social Security and Medicare taxes. And then lastly, it's going to be reflected on box 14 of your W-2, and there will actually be a special code that will say S Corp Health and then the premium total. So it's a very interesting concept here, and I learned about this long ago when I first started out. And I had, just my first job in public accounting, and I had the experience of working for somebody that was very experienced. And, they handed me the file, and I looked at it, and I wasn't sure what to do with this W-2 because it looked very different from all the other ones. And so the partner gave me a wink and explained to me that this is an old tax strategy that must be implemented this way. And he sent me to read the regulations and publications that basically discusses the how this is reported. Now, you can also find this on the instructions to the 1040, and so that's basically it gets reflected as income as it's passing through this W-2, and then it's being subtracted out as an adjustment to income to basically arrive to your adjusted gross income. So if you picture it, your gross income on a tax return is all income from all sources. And then you have these adjustments, these reductions to income. And those reductions can be health insurance, your HSA contribution, IRA contributions, a whole host of other ones. And then those adjustments or deductions from your gross income arrives you to your adjusted gross income. Now, basically, once you understand how that works, you'll understand that you have the income coming in as deemed compensation from this health insurance as income with your other wages, right? And then it's backed out and it arrives to adjusted gross income, so it's a wash. It's basically zero. Meanwhile, it wasn't taxed for Social Security and Medicare. It's a perk, right? It's a fringe benefit, so it shouldn't be taxed. But at the same time, since you have a pass-through entity, all the profits from the entity are still passing through to you via that K-1 form, and that's basically being picked up on your return where it's being subject to income tax, right? The profits from your S corporation or partnership, they're all taxed on an individual level. The entity doesn't actually pay income taxes, right? It actually passes through everything to the owner, and that's where it plays out. So if you picture it again, like the money comes in on the W-2 as income, it's backed out as an adjustment. Meanwhile, the K-1 is bringing the profit, which has the reduction for your salary and for that deemed compensation for the health insurance. So it's actually a reduction. I know it sounds crazy, but this is exactly how it has to be reported. And if you're curious, you can go on Google and just put in 1040 instructions and go to the section that deals with adjustments to income, and the instructions are there. And you can see that they're very specific, that it says that if you're an owner of an S corporation, you have to report the health insurance premium for greater than 2% shareholder through the W-2 through payroll. So if you go to payroll, to your payroll module, and you look for fringe benefits, you will find that there's a very specific fringe benefit that actually says greater than 2% shareholder of an S corporation. And that's where you put in the premium. Now, this premium you can pay directly out of your business, or you can reimburse yourself from your business, and it would still be treated the same way. But the key is that it has to go through your W-2 and it has to be reported that way. Additionally, this premium can cover yourself. It can cover your family members, and there are, obviously, it has to be, not all insurance is applicable. I mean, there's some insurances out there that aren't like real insurance. They're kind of like a market of some kind where people just share costs, but it's not like your traditional insurance like Blue Cross Blue Shield or Hartford or something like that. So just keep that in mind. So not all insurance types apply. Cobra can apply as well. Just keep that in mind. So if you just started a new venture and you paid for Cobra from another employer, that can apply. But there are certain instances, I'm not going to go into the small instances where it doesn't apply. Just keep it in mind. Also new for 2023 reporting and going forward, now this has to be reported through Form 7206. This is a new form that is now reporting the health insurance premiums of self-employed individuals, such as the ones I just described. And you also need to know that you can't double dip. So if you're basically receiving a premium tax credit from your from the marketplace, so you have insurance from marketplace, and it was you're receiving a tax credit for that, you'll probably know what I'm discussing. It's the premium tax credit, and you cannot have both. You cannot get the deduction above the line, and you cannot receive the tax credit below the line. That's considered double dipping. Now remember, the key difference is between deductions and credits. A deduction actually saves you 1% of your tax liability, where the tax credits actually reduce your tax liability dollar for dollar, right? So if I have $100 in tax deductions and I'm in the 20% bracket, it's only saving me $20 in actual tax liability. But if I have tax credits of $100, I'm actually saving tax dollars of $100. So it's dollar for dollar. Keep that in mind. So again, no double dipping on that. If you're receiving the deduction above the line, and when I say above the line, I mean above the adjusted line, then you cannot also double dip with the credit. You have to figure out which one is better for you. Okay, so that being said, that's pretty much the intricacies when it comes to the S Corp health insurance. Another great planning tip for you guys is that if you already have health insurance, see if your health insurance is a high deductible health plan, and find out if it's an HSA qualified health plan, because an HSA is a health savings account. That's where you can save money, put money into like a card where you can go and spend money on any out-of-pocket costs. For example, co-pays, for example, chiropractor, eyeglasses, anything that your health insurance doesn't cover and you have to shell out of pocket, that would be lost money. So let's see exactly how that would play out. So let's say I have all these out-of-pocket costs, and they can really add up over the course of a year if I have a family and kids and braces and who knows what else, right? So if my health insurance is a high deductible health plan, you better believe that a lot of stuff is not going to be covered. So everything just you keep paying. And so where do you report this? Do you get the benefit, Greg? No, you do not. You actually lose it if you're not itemizing your deductions. So your personal deductions are you can take either a standard deduction. This is below the line, folks. So this is like the second page of your 1040. Everything I described before is your first page, and that's why I'm discussing above the line or below the line. So once we get to below AGI, Now we're dealing with two types of deductions that are very specific, either the standard or itemized. And if we're itemizing our deductions, only then will we be able to use medical deductions if and only if they reach over 7.5% of our AGI. So in case you're trying to understand what the heck I'm talking about, that means that most people will not utilize them because there's just too many limitations to actually be able to utilize them. So unless, God forbid, you were very, very sick and you had extremely high medical costs, you would most likely not deduct your medical costs, out-of-pocket medical costs, on your tax return. They would just be not deductible because they're lost. So even, $3,000, $5,000 worth of medical would just be gone. Why lose it? Why not just put it through your HSA? Open up an HSA account and then contribute towards that HSA. You get a card, you go with anything that's out of pocket, and you can pay for these costs with this HSA, and all of a sudden you have deductions where there were none, where they would be gone because you wouldn't be itemizing and you wouldn't be filling Schedule A, and they wouldn't be lost because of the limitations of Schedule A. So this is another great tip. Now, how is this treated for an S Corp? Great follow-up question. HSA contributions are treated the same way as health insurance is treated for an S Corp. So the tax law doesn't differentiate and they're both treated the same. They would both be reported the same, just on slightly separate lines, but they would both need to go through your payroll, through your W-2. So just keep this in mind. This usually goes hand in hand. Most people don't know about this, and they usually miss the opportunity to get both the health insurance properly deducted, and of course they're out of pocket because they don't open up an HSA. Again, the key is that you have to have a high deductible health plan, and it has to be an HSA qualified plan. You can easily figure out if your health insurance is an HSA qualified plan by simply logging on to the website, taking a look at your plan, and it'll tell you right there if it's an HSA qualified plan or not. All right, so the tax law treats it the same. Now, is this the same for partnerships and LLCs and single member LLCs? Yes. It's treated the same way, it's just reported slightly differently. There is no W-2 requirement, but for example, for partnerships, these are guaranteed payments, and they have to be reported separately on the K-1 forms, which is part of the partnership filings, but it would flow through to the personal return the same way of an S Corp would, and it would work very much the same way. So it's the same strategies because the tax law is not going to really differentiate one over the other. It's just a matter of how they want to see it reported, which is odd, I know, but nobody said it needs to be not odd, right? All right, so that's basically the reporting aspect. Another neat little thing that most people don't know about is the long-term care insurance premiums will be treated the same way. So again, it's health insurance premiums, it's your HSA contributions, and it's your long-term care premiums. All those three, for tax purposes, for pass-through entities and for the self-employed that are pass-through entities, would be treated the same way, and you wouldn't lose it on Schedule A. So you want to put it through your business. Now, of course, you need to look into the details, talk to your tax advisor, make sure that you're getting it all right, that whatever documents need to be in place are put into place, and that you're putting it through properly where it has to be put through properly and reported properly. That's it, folks. So that's basically my discussion today on the health insurance. I think I pretty much covered everything that I think that is key to know to succeed and get the most out of the tax system. Remember, guys, our motto here at Freeman CPA, Atlanta Business Accountants, is your success is our success all day, every day. And we take that very seriously. We want to make sure that you know everything that we know so that you can get the most out of the tax system. That's really important to us. We want to empower our clients. We want to empower the people, give them the knowledge and the tools to make the best and most out of this tax system. It's already difficult for everybody. There's tons of costs everywhere. So why not get the most out of it? All right, thanks again. I'll talk to you later. Bye.